They wanted a silent night. The bankers on Wall Street wanted to go home early. They wanted to close their books, shut their screens, and forget about the markets until January. It was supposed to be the quietest trading session of the entire year. Liquidity was thin, desks were empty, phones were silent. Risk managers were already mentally on vacation. This is the dangerous part of financial markets that very few people truly understand. Silence is not safety. Silence is vulnerability. Holiday markets create an illusion of calm. Volume drops. Volatility appears muted. Spreads widen quietly in the background. Behind the scenes, the system becomes fragile. When fewer participants are present, price moves become exaggerated. A small push can cause a massive reaction. This is not theory. This is how every major market shock begins. On paper, nothing should happen on a day like this. No major data releases, no central bank announcements, no earnings reports, no headlines that justify chaos. Yet history repeatedly shows that the most violent moves occur when traders least expect them. Markets do not respect calendars. Markets do not care about holidays. Markets only respond to pressure. Pressure was building quietly, not in public, not on social media, not in retail trading accounts. Pressure was building inside balance sheets, inside derivative books, inside short positions that had grown too large over time. Silver was one of those pressure points. For years, silver had been treated as a controllable market, a market where price could be managed, a market where supply narratives could override demand reality, a market where large players believed they could always exit positions without consequences. That belief works until it doesn't. Short positions accumulate slowly. They feel safe when price stays range-bound. They feel safe when volatility is suppressed. They feel safe when liquidity is deep. But holiday markets remove that safety net. Depth disappears, bid support weakens. Stop losses cluster closer together. Margin requirements suddenly matter. The public rarely sees this layer of the market. Retail traders focus on charts. They focus on patterns. They focus on indicators. Institutions focus on survival. They focus on risk exposure. They focus on what happens if price moves violently when no one is there to absorb it. Risk management is not about predicting price. It is about controlling damage. A risk manager does not ask whether silver should go higher. A risk manager asks what happens if silver does go higher. That question becomes terrifying during holidays. Imagine holding millions of ounces of short exposure. Imagine price breaking key technical levels. Imagine liquidity evaporating. Imagine waking up after a holiday to a gap higher that cannot be hedged. This is how firms go bankrupt, not through slow losses, through sudden dislocations. This is why holidays matter. They compress decision-making, they force traders to act early, they remove the luxury of waiting. If something goes wrong, there's no time to react. The only solution becomes exit. Silver had been approaching a critical zone, not a random number, not a headline figure, a level where risk models begin flashing warnings, a level where margin requirements change, a level where losses accelerate exponentially. That level was near $70. Price does not need to stay there for long. It only needs to trade there briefly. Algorithms respond instantly. Clearing firms recalculate exposure. Risk desks reassess assumptions. What was acceptable yesterday becomes unacceptable today. This is where public narratives break down. People assume price movements reflect new information. Sometimes they do. Other times they reflect fear. This was not about optimism. This was about containment. As silver pushed higher, desks began paying attention. Not excited attention, alarmed attention. Screens that were supposed to be ignored suddenly mattered again. Phones that were supposed to be silent started ringing. Risk managers returned to their seats. The first level failed quietly. $70 did not hold. There was no dramatic headline, no breaking news alert, just a slow realization that support was gone. Then 71 failed. Faster this time. More decisively. Stops triggered. Losses widened. Each dollar higher increased pressure nonlinearly. Short positions bleed more as price rises. Margin requirements expand. Collateral demands increase. This is mechanical, emotionless, unforgiving. At this stage, it is no longer about market opinion. It becomes about math. If price continues higher, exposure becomes unmanageable. If price gaps after the holiday, losses become catastrophic. Waiting becomes the worst possible decision. This is the moment where theory meets reality. Traders do not debate narratives. They execute orders. They flatten risk. They reduce exposure. They survive. Public observers often misinterpret this phase. They call it manipulation. They call it conspiracy. The truth is simpler and harsher. Risk systems do not negotiate. They issue commands. As silver approached $72, the final warning lights activated. This level mattered. Not because of symbolism, because of models, because of leverage, because of the structure of modern financial markets. Every large institution runs stress tests. Those tests include extreme scenarios. Holiday liquidity is one of them. Rapid price acceleration is another. Combine the two and you get forced behavior. Forced buying is not bullish conviction. It is fear-driven execution. It It ignores price, it ignores valuation, it ignores sentiment. It only responds to risk limits. This is how calm markets turn violent. Not through excitement, through obligation. As the holiday clock ticked closer to market close, time pressure intensified. The window to act was shrinking. Positions that remained open would carry risk into a closed market. That is unacceptable for institutions. By this point, the narrative was already set internally. Get flat, reduce exposure, do not carry risk. Price became irrelevant. This is the part retail traders never see. They see price spikes, they assume confidence, they assume smart money buying. In reality, they are watching exits. Silver was no longer trading normally, it was repricing risk. Each trade reflected urgency, each tick higher amplified stress. The calm holiday session was gone, the illusion shattered. What replaced it was inevitability. This was not the end, this was the beginning. When $72 broke the system. Markets do not break suddenly, they fracture first. Small cracks appear long before collapse becomes visible. By the time price reached $72, the system was already compromised. What followed was not chaos, it was process. $72 was not magic, it was mathematical. It sat at the intersection of leverage, margin, and illiquidity. Above this level, losses no longer grew linearly. They accelerated. Every major bank runs layered risk limits, desk limits, trader limits, firm-wide exposure limits. As price rises, those limits are tested simultaneously. $72 triggered multiple thresholds at once. When thresholds are breached, discretion disappears. Risk managers do not ask permission. They issue instructions. Those instructions are not suggestions. They are enforced. This is where the idea of panic buying becomes misunderstood. There's no emotion in the order itself. The emotion exists behind it. The trade is mechanical. Short positions behave differently than long positions. A long can only lose what it invests. A short has unlimited risk. That reality becomes very real when price accelerates. At $72, mark-to-market losses exploded. Collateral posted yesterday was no longer sufficient. Clearing firms recalculated requirements in real time. Margin calls were triggered automatically. Margin calls do not wait for explanations. They do not care about narratives. They demand action. If collateral cannot be posted immediately, positions must be reduced. During normal market hours, this process is manageable. Liquidity absorbs exits. Prices adjust smoothly. Holidays remove that buffer. Thin liquidity means fewer buyers and sellers. When forced buyers appear, price gaps higher. Each gap triggers additional margin pressure. This creates a feedback loop. Feedback loops are the most dangerous force in markets. They turn manageable problems into systemic events. This was one of those moments. Banks attempted to stabilize exposure. They tried partial reductions. They tried incremental buying. It did not work. Each attempt pushed price higher. At this stage, strategy collapses into survival. Risk desks abandon optimization. They prioritize certainty. Getting out becomes more important than getting a good price. This is why volume suddenly spikes during liquidations. Not because confidence increases, because exits cluster. As silver traded above 72, algo-driven systems activated. Execution algorithms chased liquidity. They crossed spreads aggressively. They accepted worse prices to guarantee fills. This behavior is visible on charts. Long candles, minimal pullbacks, relentless upward pressure. To outsiders, it looks bullish. To insiders, it looks dangerous. At the same time, related markets reacted. Gold began accelerating. Currency markets destabilized. Correlation models updated rapidly. Risk systems do not isolate assets. They treat portfolios as connected organisms. Gold crossing major levels added confirmation. Not confirmation of value, confirmation of stress. When gold and silver move together aggressively, it signals systemic repricing. Risk managers understand this signal. They respond by reducing exposure across the board, not just in silver. This is how localized events spread. One market forces action. That action impacts others. The system tightens. Retail narratives often describe this as a squeeze. Sometimes that is accurate. Often it is incomplete. This was not a coordinated attack on shorts. It was a defensive retreat. Defensive retreats are violent. They ignore price sensitivity. They move quickly. They end abruptly. By the time most observers noticed what was happening, it was already advanced. The key decisions had been made. Orders were already in the market. $72 did not cause the event. It revealed it. It exposed fragility that already existed. This distinction matters, because it explains why price moves feel sudden. They are not spontaneous. They are delayed reactions. Once forced buying begins, it feeds on itself. Each executed order reduces available liquidity. Each reduction increases impact. This is why reversals rarely occur immediately. Eventually, the forced activity exhausts itself. Positions are flattened. Margins are restored. Risk limits are respected again. Only then does price stabilize. But stabilization does not mean resolution. It means transition. The system has changed state. Exposure has shifted. Assumptions have been invalidated. What happens next depends on what remains. Some shorts are gone, others survive. Some longs enter late, others take profits. This is the aftermath phase, and it carries its own risks. Liquidation events feel like endings. In reality, they are transitions. They mark the point where one structure fails and another begins to form. After forced buying exhausts itself, markets do not return to normal. They reset. A reset does not mean predictability. It means uncertainty shifts hands. Risk moves from those who were overexposed to those who arrive late. This is where misunderstanding becomes dangerous. Public commentary often frames liquidation as victory. Someone won, someone lost. The truth is more complex. Losses were realized. Exposure was transferred. Risk did not disappear. It relocated. After the $72 event, the first change was psychological. Institutions reassessed assumptions. Levels that once felt safe no longer did. Models were updated. Stress scenarios were expanded. Risk managers remember events like this. They alter behavior for months, sometimes years, not because of emotion, because of accountability. Every liquidation leaves an audit trail. Why was exposure allowed? Why were limits insufficient? Why did controls fail? Those questions reshape future positioning. This is why post-liquidation markets often behave differently. Volatility patterns shift. Liquidity providers become cautious. Spreads remain wider. Participants who survived become defensive. Participants who exited early feel validated. Participants who entered late face uncertainty. This is where narratives explode. Claims of guaranteed upside appear. Predictions become absolute. That is the most dangerous phase. Gold often becomes central to these narratives. When gold moves sharply alongside silver, assumptions multiply. People search for inevitability. They want confirmation. Gold crossing major levels is meaningful, but not because it guarantees anything. It signals macro stress, currency pressure, confidence erosion. Gold does not predict silver. It contextualizes it. The relationship is dynamic, not mechanical. After liquidation, correlation increases temporarily. Assets move together. Fear synchronizes behavior. That phase does not last forever. Eventually, differentiation returns. Fundamentals matter again. Positioning matters again. This is where many retail traders misstep. They assume momentum is permanent. They ignore structure. They ignore positioning. The idea of a greatest wealth transfer is appealing. It suggests destiny. It suggests fairness. Markets do not operate on morality. They operate on leverage. Wealth transfers occur when leverage is misused. Not because assets rise, but because positions fail. Some benefited from this move. Many did not. The winners were not those who predicted price. They were those who managed risk. This distinction matters deeply because it defines what comes next. After forced liquidations, markets enter a digestion phase. Price may consolidate, it may retrace, it may remain volatile. There is no rule. What is certain is that volatility attracts participation. New players arrive, old players reevaluate, liquidity slowly rebuilds. This rebuilding phase determines sustainability. Without it, further upside becomes unstable. Institutions will not immediately re-enter shorts. Memory lingers, risk tolerance shrinks. This creates asymmetry, downside pressure weakens, upside resistance also forms. The market becomes balanced, not calm, balanced. Balance is misunderstood. It is not stagnation, it is tension. During this phase, headlines mislead. Every move is framed as confirmation. In reality, it is exploration. Price searches for acceptance, where buyers and sellers agree. If acceptance forms higher, structure strengthens. If not, volatility returns. No outcome is guaranteed. That honesty is essential. The role of central banks looms in the background. Liquidity provision, currency management, policy signaling. Markets anticipate reactions, sometimes incorrectly. Assumptions about intervention often fail. Timing is uncertain. Impact is uneven. This uncertainty feeds volatility. For silver specifically, supply narratives resurface. Industrial demand, inventory levels, delivery constraints. These factors matter, but not in isolation. They interact with positioning. Positioning determines impact. Crowded trades amplify moves. Empty trades absorb them. After liquidation, positioning is cleaner. Cleaner does not mean bullish. It means clearer. Clarity invites participation. Participation rebuilds liquidity. Liquidity stabilizes price. The cycle repeats endlessly. It is not unique. It feels unique when experienced. The greatest mistake is assuming linear continuation. Markets rarely reward that belief. Risk remains asymmetric. Upside may exist. So does downside. Holiday events distort perception. They compress time. They exaggerate moves. Normal conditions return gradually. As markets reopen fully, new information arrives. Data, policy signals, geopolitical developments. Each can reshape trajectory. Those who survived liquidation events understand one truth. Markets do not owe anyone continuation. This is why professionals reduce conviction after chaos. They wait, they observe, they adapt. Confidence returns slowly, never immediately. Retail enthusiasm often peaks at this stage because volatility feels like opportunity. Sometimes it is, often it is not. The difference lies in preparation, understanding structure, understanding risk. This documentary is not a forecast. It is an explanation. $72 was not destiny. It was a trigger. Triggers expose systems. They do not define outcomes. What happens next will be shaped by behavior, not belief. Markets reward discipline. They punish certainty. The liquidation phase is over. The story is not.